Why don't we,
oh, the big prize,
so.
I was thinking, were you getting blinded by the projector?
You did were you?
An exchange?
I thought it was maybe pointed right at your eyes.
Oh.
Good, how about you? How do you feel about it?
Good.
Yeah.
Good.
Yeah,
I think
good
this
job.
is a great opportunity.
Good job finding this.
Yeah, oh, good.
Well done.
Good strategy.
I know.
Good, how you doing? Good idea. Good, how are you?
We're great. Good.
Nice to meet you. Yeah, yeah. Good. Well, you're here. Yeah. I might have looked at it before she did. Brought on Suzanne.
How are you?
I'm great.
I'm good. Saw you were back behind the drum set again.
Finally.
Okay.
Oh, it feels so good.
Did it? Good for you.
It's like everything makes sense.
Yes, that's awesome. You could see it. Your face, you were very excited.
Yeah. It's funny how that gives me inspiration.
Right on the wall.
There you go. Very cool.
The reason's there, you know why.
Right? Yeah. I like it.
How are you?
Absolutely. Thanks for having us.
Yes, I never, well, my cap reset is August 1st. So I just started. Okay, yeah. And I was here for 2.5 years. And then I went to 13. And then I went to the national class. There. Yeah. And then when I decided when I left, and I know I'm not very much.
I left the voice go yesterday.
All right, guys, let's plan on getting going here so that we can do our best to stay on track timing wise. Probably have a few people sneaking in from the kitchen is my guess.
You know, what's that?
You know, this is right there.
Are you giving me a hard time?
No, I just like, I can't hear what you're saying.
Yeah.
Ryan, do you want your water?
I don't know.
Feel free to roll. Very smooth. Okay, feel free to roll. And get out of that. So whatever works for you, you put it wherever you want it. All right, let's get this kicked off. We talked about several different strategies, approaches to investment real estate. And I think, anyways, a key portion of that discussion should be geared towards what do we do with properties when it's time to move on to another one. So we have invited Patrick Harrigan in from Game 1031 Exchange. I have personally used Patrick's services here a few times in the last year or year and a half. I think he's done a pretty good job because I'm not in jail. So he's done something right. At least I'm not there yet.
That's a great day.
But no, in all seriousness, Patrick was absolutely straightforward, super pleasurable, and easy to work with. And I can tell you that my closer on, it was either 2 or 3 that we've done together, said, hey, can I share this guy's name with other people because he has been fantastic. So if the closers are saying that, it's probably a pretty good sign. So I'm going to let Patrick lay out the ground rules for his discussion. The floor is going to be his. I'll be here to chime in, help out with whatever I can. But please welcome Patrick, and let's hear what he has to say and what he can teach us today.
Appreciate it, Colin, thanks. I guess we're gonna Zoom this too, so that's why I pulled out the stool here to try to stay in one place as much as I can. I'll do my best for that. Colin said he's like me, he likes to roam around once he kind of gets going.
This is true.
So I'm gonna give you a little bit more bio about myself, talk about exchanges, talk about what we do. I think we had talked about maybe half an hour or so-ish of material, and then certainly ask me questions as we go through it too. But then we reserve a little more time after that for some questions. So happy to do that, thrilled to answer questions, want to make sure I'm covering what you want to know, which I think I will start with at least some of those basics on that. But yeah, any questions you have, please let me know. So I'm with a company called Game 1031 Exchange, and we are an intermediary for exchanges. I'll get into what that means a little bit more for anybody not familiar with it. We facilitate 1031 exchanges. So that's what I'm going to talk about. I'm going to hit the who, what, where, when, why, how, some of those basics. Exchanges can get involved when you start to get into what if this, what if that. So the goal here today, of course, is to try to cover, again, some of the basics of the process, and then at least give you an idea of what it is. And then for yourselves or clients, you can bring it up and say, hey, this might be something you want to take a look at. All right. So I've been doing exchanges since about 06. So what's that? 14 years? No, more than that. 16. With this office now since 2010, so about 12 years. I do have a law degree, so I'm an attorney. I don't do any law practice. As an exchange company, we have to be an independent third party. So I can't be someone's attorney also. Exchange companies cannot be the customer's real estate agent, accountant, employee, can't be related to them. We have to be an independent third party that just facilitates that exchange. So that's all I do is manage this office for a 1031 exchange. I've got the certified exchange specialist through the FEA. FEA is just a trade group, national trade association that has that specialist designation. Have to have a certain level of experience, take a test, keep up credits, all that. All right, okay, so what are we talking about, 1031 exchange? You might hear the term like-kind exchange, you might hear starter exchange, you might hear tax-deferred exchange, 1031 exchange is probably more typical, all the same thing. All referring to section 1031 of the tax code, which gives you the ability to do an exchange. And what is an exchange? Well, it's avoiding, or better said, deferring some capital gains tax when you sell some property. We're not talking about your home. As you probably know, there's a whole different section of the tax code that deals with selling your home and avoiding capital gains tax on that. As you probably know, most people don't pay capital gains tax when they sell their home for that reason. What we're talking about is investment property or business property or commercial property of some sort. Right now, the biggest market for us, we'll take any orders that come through the door, of course. But the biggest players right now for us, as far as when the phone rings, is probably smaller end investment properties right now, just because it's a rolling market. We do some hotels, we do some office buildings, some farmland, it's a little of everything. That all works with an exchange. But investment properties right now, again, is just tracking the market. That's a big piece of what's coming through the door. So that's what we're talking about, investment properties. Let me give you a little example. Let's just say someone buys a duplex for $400,000 and they're selling it now for $500,000. So that gain, that's the correct term. Sometimes when I'm talking with customers, I'll throw out the term profit. It's not really the correct term technically, but it's more human nature to think of that as profit. So that's what's taxable, that $100,000. So that's what we're really talking about. If you just sold that property, that $100,000 would be taxable. I'm not going to get into the weeds of how that gets taxed. You've got capital gains tax. The longer you own that property, you're going to have some depreciation, which actually lowers that basis, that $400,000 basis. So that profit will actually grow the longer you own the property, because depreciation can get recaptured. And there's net investment income tax at federal level. The state's going to ding you too, so it adds up. My rule of thumb that I throw out after I say, talk to your accountant, because we can't run those numbers. Your accountant needs to figure out that basis and those numbers for you. But my rule of thumb is probably 25 to 30%. Again, it depends on how long you've owned the property, how much is depreciation recapture, sometimes more. But if you want a good rule of thumb of that $100,000, tax bill could be $25,000. So that's what we're trying to avoid. Trying to avoid writing that check. And section 1031 of the tax code says, if you sell that property, you go through the right process, you buy a replacement property, then you don't have to pay that tax. That section of the tax code essentially says you've just traded or exchanged the old property for a new one. And you defer the gain. So that's the proper term. And I say that because that gain or that profit just rolls from the old property into the new. That's what you do. And that's why you don't pay the tax. So the tax code has various policies for why that is. But the idea is you didn't cash out. You simply exchanged that old property for the new one. You just continued that investment into the new property, and that's what allows you to defer that tax. All right, so who can do an exchange? Well, really anybody facing tax when they sell a property can do an exchange. If you're selling a property, perfect, you can do an exchange. Business entities can do an exchange. I'll talk about LLCs a little bit just because it comes up so much in investment properties. If anybody has any questions on that, let me know. But a lot of people do hold investment properties in an LLC. It's a topic we talk about quite a bit. LLCs are unique in that an LLC itself, there is no tax filing for an LLC. You can't go on the IRS website and say, I want to file an LLC tax return. There is no such thing. Well, that's because even though LLCs are very popular, they get taxed under one of the other categories or taxpayers that do file tax returns. A single member LLC is typically going to be a disregarded LLC, which means if I, Patrick, own an LLC, I'm the only owner, the IRS is by default going to look at that as a disregarded LLC. It means the LLC doesn't file its own tax return. I tell people the LLC and you are considered really one and the same from a tax standpoint. So when you do an exchange, you've got some options there. That customer selling the old property can buy the new one under their name or under an LLC, either the old LLC or even a new LLC if they wanted to, and I see that quite a bit. As long as they're the single owner of that LLC, it all rolls up to that person's tax return. And again, the IRS just sees them as the taxpayer doing the exchange. So at the local level, county level, the title might be different, but from an IRS federal standpoint, all the same person.
Is single owner also mean married couple or literally a single owner?
Not in Minnesota, it doesn't. In Minnesota, and I differentiate Minnesota because there are some community property states, Wisconsin's one of them, where a husband and wife can own an LLC and it's still considered disregarded. But in Minnesota, a husband and wife owning an LLC, technically that should be a partnership. It should be filing a partnership tax return.
And is a living trust
It doesn't
considered?
always happen, but it should be.
What about a living trust? Is that?
Trusts depend on how they're set up. Most revocable trusts will be like a disregarded LLC. They don't file their own tax return. You can have those are called grantor trusts usually, but some trusts do. So it depends on how the trust is set up. You can have irrevocable trusts that do file a trust and estate tax return. So then you'd consider that, usually you'd consider that a separate tax. So it depends who it is. The general rule that I'm getting at with an exchange is whoever sells the old property has to buy the new one. So if you do have an LLC with multi-members, it's a partnership. It should be filing a partnership tax return. And then the partnership should be doing the exchange if the partnership is selling the old property. Because again, it's its own taxpayer. So it has to sell the old one, it's got to buy the new one for the exchange to work. And that is a discussion we have quite a bit with people if they've got partners and the partners don't necessarily want to stay together. How do you deal with that? It depends what their ultimate plans are, but there's certain ways to work around that, but something might have to be done to adjust that. All right. So let's get into the process a little bit. At one time, the only way, and this was, you could do exchanges for about 100 years now in the tax code. It's been around for about that long. But for many decades, the only way to do an exchange was just a trade. It's like, I say like two kids trading baseball cards. So I'm deeding my property to you, you're deeding some property back to me. Boom, we consider that an exchange. Obviously that is. Then in the late 80s, early 90s, there was that Starker case and some regs, changing the tax code, some regs that came through from the IRS that said, you can actually do a deferred exchange or a delayed exchange, meaning you can sell to somebody here today, buy property from someone else down the road, and you can still consider that an exchange. The IRS will still consider that as a trade of the old property for the new one, or just a continuation of that investment. So that's where we come in. So at that time, that's when qualified intermediaries came into the picture. Again, without getting too deep into the weeds, we connect those properties together, and as long as you go through that right process, that's what allows the exchange to be considered an exchange. So what do we do? Well, I tend to tell customers, boiled down, we really do two things. One is the paperwork. Of course, there's some paperwork to set up that exchange with an agreement with us to be the intermediary. The other key piece, and this is top of the list, is the exchanger doing the exchange cannot touch the proceeds coming out of the property they're selling, the old property. And I think that's pretty easy for most people doing an exchange if they never did one before to wrap their heads around. If you touch that money, then you sold the property, you cashed out, it's taxable no no matter what other intent you may have had. So again, that's where we come in. We set up what's called an exchange escrow account. Proceeds from the old property sale go into that account. And then, of course, they're there to be used to buy whatever property you're going to buy. But that's the key piece of doing an exchange. Can't touch that money. It is possible to do a partial exchange. So if somebody says to me, hey, I want $20,000 from this sale, fine, you can do that. But the way the IRS calculates an exchange, that's going to come out of that taxable profit piece first. So anything you touch is coming out of the taxable piece first, going to be subject to tax. All right, so another key point that I always like to iterate with people is, again, the way the IRS calculates exchanges, if you want it to be fully tax deferred, you do need to buy a property at the same price or more than the one you sold. So in my example, if you sell that property for, what was my example, 500,000, I think. You'd have to buy another replacement property, or more than one, you can buy more than one, but you'd have to buy another replacement property for that $500,000 or more. And again, it just has to do with how the IRS calculates an exchange. They figure if you bought a smaller property, either you put some money in your pocket, you cashed out somehow, or you walked away with less debt. So if you paid off a mortgage on the old one, you may only have so much proceeds going through the exchange. But if you bought a smaller property and you rolled all that cash through, well, if the new property was a lower price, then you took out a lower mortgage, most likely. So either way, they consider that difference subject to tax. So that's a key thing. It tends to be, I've learned, human nature for a lot of people to think, oh, all I got to do is roll over that gain, that 100,000. Or they think all I got to do is roll over my actual proceeds. So that, let's say their mortgage on that $500,000 sale is $250. So they're getting $250. That's what's running through the exchange. They may think, oh, all I got to do is buy something for $250. Well, unfortunately, neither one of those works. You got to buy for $500 to make the exchange work. And again, you can buy it for less, but there's going to be some tax on it.
Patrick, you mentioned you can buy more than one property. Is there a limit to how many properties you can purchase as part of one exchange?
There is, yeah. Well, for the most part, there is. I'll clarify that a little bit. So that, I guess that gets me into the process of doing an exchange. So an exchange really starts when you sell the old property. At that closing, that's when the exchange starts. At that point, there's 2 time periods that start to run. So this is important to know, whether it's you or a client or whatever. When that sale occurs, when that closing occurs, there's a 45-day identification period. And that's a hard and fast time period right in the tax code. There's really no exceptions unless you're in a federally declared disaster area, but otherwise it's a hard and fast rule. So the 45 days is the time you have essentially to figure out what property you're going to exchange it. Doing the identification is just fill out the form we send you and get that back to us. But you've got that 45 days to do that. So there are a couple caps on how many properties you can identify. Today, the last year or two, I'd say the vast majority of our customers have something under contract in that time, just because they want to know what the deal is going to go through. You don't have to. The identification is purely between us and the exchanger. Again, all it is fill out the form we send you, get that back to us, and that satisfies your identification requirements. So there's 3 rules on that cap how many properties you can identify. So one is 3 properties. That one's based on the number of properties. Any 3 properties, doesn't matter what the value is, just boom, max of 3 properties. If you want to go over 3 properties, there's a second option which uses a dollar figure, and it's twice the value of what you sold. So in my example, twice the $500,000 sale would be $1 million. Under that rule, you only got to pick one. You don't got to do both. Under that rule, you could identify 8 properties if you wanted to. Now that would get tough. But if you wanted to, you could identify more than 3 as long as the total or the aggregate value of everything you identify is under $1 million. Because that's twice the value. So there's sort of a third catch-all which says, go nuts, identify whatever you want, but you gotta buy everything you want, everything you identified. So nobody ever does that, because essentially if one deal falls apart, the whole exchange goes up. So that's why I see that never happened. So the answer to your question, Colin, is there a limit? Technically, I suppose not. But practically, yeah, the limit would be either the 3 properties or that $1 million.
May I ask a question that's similar but in reverse? So let's say Colin owns 2 investment properties here in Minnesota and wants to buy a house on the beach in Florida
Which
as a
happens a
rental
lot.
property.
Yep.
So can he sell 2 but buy 1?
Sure, absolutely.
Yes.
Yep,
Okay.
yep. And that happens a lot too. Yeah. You can go in both directions. So you could sell 1 and buy 2 or 3. You could sell 2 or 3 and buy 1.
Gotcha.
There's no real limit on that. Yep. Timing is an issue, of course, if you're trying to sell 3 properties. Once you sell that first one, those time limits start to tick along. So you'd have to make sure you close those other sales in time to then close that purchase. But within the rules, you could do it, sure.
Asking for a friend.
Yeah, I'm gonna stay in your house on the beach in Florida, so. I'm gonna rent it from you.
Let's do that.
Yeah, that happens a lot, actually. We have a ton of replacement property closings that occur in Florida, Arizona, some Texas stuff, some Tennessee stuff, so that's pretty common. It still has to be an investment property for those people, but the IRS does have some, well, they call it a safe harbor, but sort of a rule of thumb on that. So it has to be an investment property at the time you buy it. It had to be your intent. So it doesn't work to then say, oh, a week later I changed my mind, now it's gonna be my vacation home, I'm gonna be there or whatever. So their rule of thumb is 2 years, 24 months. So as long as you keep it as an investment property for that time period, and if somebody's got questions on it, I can dig deeper into how much rent you need to have and how much personal use you can have. They limit the personal use quite a bit. But suffice it to say, as long as it's an investment property for that 24 months after you buy it, after that, they don't care. So then if you wanted to convert it to just a second home, vacation home for you, your main home maybe, then you'd still be fine, because you've established that your intent at the time you bought it was for it to be an investment property. So that's their safe harbor. Yeah.
So then if they, because I had some clients do this where they took a bunch of their rental properties, then sold them, rented the property for 2 years and made it their primary residence. And then there was no tax consequences when they sold eventually again. So they kind of like bought and then got out of the exchange eventually, but is that still true or no?
Sort of.
It's still a depreciation, wouldn't they?
Yeah, so it was a great strategy at one time. When I started in this business, it was a super great strategy and you could do that. So you could sell a duplex here, buy some condo in Florida, rent it out for a couple years, then move down there, make it your home. As long as it then was your home for a period of time, and that's that 2 to 5 year rule that you probably are familiar with. And then there's actually another year in there that you need. Excuse me. But then you could sell it as your home and you'd get that tax exclusion. So that was great. Well, they changed the rules on that. It's been quite a while. I want to say 10 years or so, maybe even a little more than that. So they didn't get rid of that strategy entirely, but they created a formula which says, if you do that, you still are going to get dinged with some tax that relates back to the investment nature of that gain sitting in that property. So the formula looks at how long you then live there as your primary residence. So if you live there as your primary residence for the next 15 years, you probably get rid of most of that tax. But if you just did a couple years, then selling it as your primary residence at that point, you're probably going to still have to bite the bullet on some of that tax at least. Yeah. So that strategy again was great. Still kind of works depending on where you end up in the end. Other questions? I'm gonna see if I'm missing anything on my notes here. All right. So there's one other time period I didn't mention. A couple other things I didn't mention. Okay. So I mentioned the 45-day identification period. The other time period is 180 days to complete the whole exchange. That goes from closing of the old property to closing the new property. Today, not too many of our files run into that time period. Obviously, the 45 days is the tougher one. That's the one that sneaks up on you. But most of our files don't run into the 180 days. On occasion, we get that, but usually things, once you got it rolling, close before that. Some of the commercial deals, of course, takes longer. But that's a hard and fast rule too. That's right in the tax code. Got to get that closing done within that 180 days for the exchange to work. Bigger picture, looking at the whole thing, for the most part, doing an exchange doesn't really mess with your transactions. Somebody selling that duplex in my example, you're still going to list it. You're still accepting an offer from a buyer. We recommend put a couple sentences in there related to the exchange. Closing's going to go as it normally would, with the exception of a little tweak to the closing statement. We like to show just the evidence that those funds didn't go to the seller, that they became exchange funds. Some paperwork that the exchanger signs, but that doesn't really mess with the closing any. Buyer doesn't care. The buyer does need to get notice of the exchange, so that's in some of the paperwork, so we do ask the buyer to sign. That's IRS rules. But otherwise, buyer doesn't care, it doesn't cost them anything, doesn't change anything on their side of things, so they really don't care. Replacement property, same deal. You're going to put in an offer, you're going to go through that closing as you normally would. Obviously, at that point, the exchange funds are funding part of that purchase. So that money's coming into that transaction. But the purchase agreement's the same, closing's generally the same. So it really doesn't mess with any transactions any. Of course, the beauty of it is then when tax time comes around, you can report that you ran through that process and that you can avoid paying that $25,000 or $30,000 or whatever it is, and roll that fund, keep it working for you in that replacement property. So that's the basics of it. There's different parts of exchanges or types of exchanges that we do. We do reverse exchanges where somebody's trying to buy first, changes the process quite a bit, and changes the fee substantially because it's a more involved process. It is possible, so if anybody's got questions on that, I'm going to dive into that a little bit. It is possible to do some construction on the new property during an exchange, but that's also changes the process a bit. So we do quite a few of those unique, more involved exchanges. Typically, they're not going to be a duplex deal. They're going to be more of a larger commercial deal. But we do facilitate those also. I guess those are the main types of exchanges.
What about farmland?
At one time we did a lot of that, and then that dropped off. It's coming back a bit just because of commodity prices, but yeah, absolutely, that's a big exchange market. Yeah. It's a big exchange market because typically a lot of customers we run into, they've owned that forever. And so what they paid for, their basis in that property is probably nothing.
Right.
And now they're selling for $1 million. So it's going to be substantially taxable. They don't have any depreciation recapture because you can't depreciate land. But if they paid 100 grand for it and it's now $1 million, that whole 900 gets taxed. Yeah. Now, typically those customers are buying other farmland, so it works great. And frankly, I think that's where exchanges got their start 100 years ago. Yeah. farms saying, for whatever reason, I want that piece on the other side of the road, and two neighboring farms decide we're gonna trade some properties. No money changed hands, so there wasn't any money to pay the tax anyway. So I think that's where the policy got started in the first place, yeah. So that's a pretty decent exchange market.
And Patrick, you could then theoretically sell that farmland and maybe buy a commercial building as part of the exchange.
Yes, yep, that's a good point.
If you were renting out farmland, it doesn't have to be like property, income producing? Or is it?
So that's what I was gonna kind of get at is, there is the terminology like kind in the tax code, but when you start talking about real estate, like kind is actually a very loose definition. You do not have to sell farmland and buy other farmland. You could buy an apartment building if you wanted to. As long as it has some kind of investment, commercial, business nature to it, it does not have to be the exact same type of property. You don't have to sell a fourplex and buy another fourplex. You can, of course. You do not need to do that. So farmland, either farmer farming it or somebody owning it and renting it to a farmer, that all works because it's all investment property. Yep, absolutely. All right. Other questions?
My favorite agent, Tommy Callahan, gets a listing. And when does from there, he just gains the listing, and this is now in Tommy's mind. What do I gotta do? Does he have his client call you? When do they call you? Does he call you? What does that process look like to engage your service?
Yeah, that's a good question. We always prefer to do at least some kind of little consultation with the customer. So, and the sooner the better, of course, happy to do it. We get all kinds of emails from title closers saying, hey, we're closing a deal Friday and the customer wants me to exchange account. And that's perfect. We do that all the time, make it work. But we do like to at least chat with the customer. Just to kind of go through some of those issues I just did, or just said. For instance, they might be selling that duplex for $500,000 and they think, oh, I'm gonna get $250 of proceeds. I'm gonna go buy my aunt's little house in St. Paul because she needs to sell for $250. And I'm gonna do an exchange. Well, that exchange might not do you any good. I might tell them, hey, run those numbers. With those numbers, you might have wasted your time doing an exchange. So we like to at least do a little phone consult with that seller, go through some of those numbers a little bit, make sure they realize it has to be an investment property, go through the 45 days, 180 days so they know what it is. Ask them who actually owns the property, because that's tricky sometimes too. People will say, yeah, I'm selling some property. Well, then when I get the title work, oh yeah, my brother owns a little bit of that too. Well, so now we gotta figure out what the brothers can do. So yeah, that's always our preference. Even if they haven't even listed it yet, great, we'll chat with you, make sure you know some of those basics. That's always our preference. But again, a lot of times it doesn't happen, it's last minute stuff, and we can still make that work.
So for my friend Tommy, that actually is more likely.
Yeah.
Can you bail out?
At the listing stage, doesn't change anything whatsoever. And as I said, even in the contract, a couple sentences in there is nice to reference the seller's doing an exchange. The rest of it is going to be normal. The big piece is at closing, we need to work with the title agent, title closer. As Colin said, we do a lot of work with title closers to make sure paperwork's covered, funds flow are covered, tweak that closing statement a little bit. Because what happens is then when the customer, at the end of the year, they're taking all their paperwork to their accountant. The accountant wants to be able to track some of that and see what they did and make sure that it makes sense to do.
I can just kind of share a scenario too. When I need to refer somebody there is when I'm on a listing appointment and I do them, if they've got a house that a family member owned or they've owned it, bought it from a family member, or it was a parent's house or something that was gifted to them, and they've been renting it out, and I do the net sheet for them. the first question I ask them when I do that, and actually when they had a rental property is, are you going to be reinvesting this in something larger? Are you doing a 1031 tax exchange? A lot of people have never even heard, or they may have heard of it, but they don't know anything about it. That's when I've referred them to somebody to do that. And Patrick's done a great job. He worked with one of my clients, and she sold a rental condo and was buying a bigger one actually she was gonna rent it to her son in Bloomington, so she was a different location. They sold one in Farmington, moved her and Bowen, and he just did a consultation with them, and he explained it beautifully to her. And then you shared with me what I needed to put in the purchase agreement. It was great. It was easy.
Yeah, thanks, I appreciate that. I'm not an accountant either, and as the intermediary, I can't be your accountant, as I mentioned. So at some point, we do suggest customers talk with your accountant, because you need to know what that basis is in the property you're selling. And the longer you own it, the more that goes down. It might take some calculation to figure that out. Even if I wanted to or could, I can't figure that out. That's the accountant. Look at your past tax returns, all that good stuff. It's something we encourage, just because if you, again, in my example, you paid 400, you're selling for 5, you got 100 grand of gain. That's going to get taxed. But if you paid 4 and you're selling it for 4 1/4, and closing costs are going to eat up some of that, and you might not have that much tax to defer. So we always do say, talk with your accountant, run those numbers. The majority of the time, it's pretty obvious. If you own something for a lot of years, it's worth more than you paid for, right? So it's almost a no-brainer there. But still something we say, run some of those numbers, make sure you know where you're going with it, what makes sense. Yeah. I hate getting the calls where people say, somebody gave me your name, Patrick, and I'm interested in doing an exchange. So I start talking with them, and it's Tuesday, and they said, oh, I sold this property last Friday, and we closed on it, and I got this check in my hand. It is too late. Yeah. The rules, if nothing else, the rules are absolute on you can't touch that money. Even if you're sitting in a closing, we get those calls. I want to set up an exchange, I'm sitting here at closing signing. Let's hit pause, we can get that, working okay. We can still set that up. But if you close it last week, yeah. And so, yeah, if nothing else, great to have those sellers selling that kind of property to know in advance to at least look into it. If it works for them, great. If it's not something they're interested in, fine. But at least great to have them know about it. The last couple of years, I'd say, not less than I anticipated actually, but we do have more customers that start an exchange, get to that 45 days and say, I just couldn't find anything that I wanted to find. That's up just because, as Kyle and I were talking about, it's been a seller's market, not a buyer's market. When you do an exchange, you got to do both. So we do have those exchanges where people start them, get to that 45th day, they say, Patrick, I didn't find anything. So then we just return the funds in the exchange account to them, and they're just going to be a taxable sale, just like any other. So they gave it a shot, didn't work. Kind of no harm, no foul there. But at least they blocked themselves the option for 45 days to try to find something to make that work. So that does happen from time to time, and just fine if that's where you want to give yourself that possibility.
Yeah. What kind of fee should we kind of warn them that would be entailed with doing the 1031 exchange? I'm assuming you collect at closing for the purchase property?
Yeah, yep. So we just do a flat fee at $850 if they're doing a sale and a purchase, meaning they're just doing one old property sale, one new property purchase. If there's multiple properties involved, sometimes we'll do a little discount on that depending on where it's going. Sometimes if they say, Patrick, I'm selling one property, but I'm buying 6, then there's an extra fee for those extra closings.
Okay.
But a standard, I'm selling that duplex, I'm buying another duplex on the other side of town, it's just flat fee, and it gets, we like to just put it on the closing statement as part of the closing costs.
Well, my other question is, I'm actually in the middle of this where I had a client that sold an investment property in Texas that was pretty large, and so we're buying 4 townhomes here.
Oh, okay.
But I kind of suggested to them is, because deals can fall apart in the inspection, and like you said, it's a seller's market, so finding 4 townhomes that we can win in 45 days was somewhat of a challenge. But they put their adult children's house on that list, like just to identify it, that if they had to, the kids were gonna let them buy their house and then like rent it back until they bought something. I mean, I don't know if that's good or bad, but that's what they did, is add that to the list as an identifiable property. Do you suggest that, since you have such a hard 45-day rule?
Well, doing backups, great. Backup properties is great. There's an issue with buying from a related party.
Okay,
So I don't know if anyone mentioned that to you. It gets the rules on that get convoluted pretty quick. And sometimes I struggle to explain it to people because the language in the tax code that relates to how that becomes an issue is just very, very vague, if you want to say that. I tend to tell people, well, you do an exchange, you can't touch any of that money. But if you buy from a related party, a family member, who's getting the money? That adult child is. So the IRS tends to think, oh, there's probably something going on under the table where you're getting some of that money
so
back
it should be
somehow.
arm's length if you're gonna do
Some
that.
kind of sweetheart deal, yeah.
Okay.
So that if you do an exchange and buy from a related party, you do gotta check a box on your tax return where you report the exchange to say, yeah, there was a related party involved here.
With 87,000 new IRS agents, I'm sure it'll get done.
Yeah, we'll see where that goes, yeah. So there's ways that it still works. So let's say the adult children do their own exchange, they don't cash out, then it's fine. You can run some numbers, and it's a big surprise if the adult children pay as much tax as exchangers would have paid by avoiding doing the exchange, then the IRS is fine. You didn't scheme up this deal with the related party just to avoid tax, because the related party paid as much tax anyway. So there's ways to make it work. There's also kind of a catch-all which says, well, if you didn't just scheme up something with the related party, then we're okay with it. Well, there isn't much guidance on what the heck that means. You know, that's literally a checkbox on the tax return too that says, well, if to the satisfaction of the IRS, you didn't involve the related party just for primarily tax-related reasons, then it's fine. Well, there just isn't a lot of guidance on what the heck that means. So if I was advising them, I'd say you can do it, but it might be something you'd have to realize that there's a low risk in it.
And it all worked out, so like everything was through inspection and everything by the 45 days, so they didn't need it.
Oh, okay, good.
So that's the good ending to the story.
That related party gets so goofy, because you gotta start with what is a related party, you start to get into business ownership and that kind of thing, so it can get goofy quick. And as I said, there isn't always a perfect answer to it. It can work.
So to that scenario, last one we did, we ended up, we sold one and bought two, if I recall correctly. And we used it to our advantage when we were making offers, because most people don't like sunset dates on offers, like sellers don't like that. They don't like to have to perform within a time frame. Well, having the 1031 time frame as the bad guy as to why we need an answer on this offer ASAP worked really, really well.
Because they didn't think you were gonna bail.
Yeah, so, I mean, we made it very lucrative for the seller. But we flat out told them, listen, here's the deal. This is a 1031. Today is the last day of our exchange or of our identification period, and it was. We weren't lying on that. And we pushed them, and they were going to wait. And we said, we just need to know by 5 o'clock, because if you're going to wait for other offers, we gotta go. It worked.
Oh, that's good.
Yep, it worked really well. We had it on the bus.
Yeah, that's actually good to hear. That's an interesting nuance with exchanges in the market that you're dealing with.
Yep.
Sometimes I get the opposite. I'll get customers that will say, I don't want to tell my seller I've got a big pile of money sitting here in a certain time frame I gotta spend it in. So sometimes people will say, I don't want them to know I'm doing an exchange. So it's like everything else, it's market driven and you idea as to what makes sense. Yeah, but that's interesting. I like that.
Yeah, I've never really been concerned about a seller knowing what there is for funds available or whatever the case is, because I mean, my numbers, so you're not going to force me into doing something I don't want to do. That's the whole purpose of this.
That's true.
Anyway, yeah, we use it to our advantage at work really well. So just a heads up for anybody that's.
I do have a question, when you're selling one and you're buying two, and you've got mortgage on one, do the combination of the two debt has to be greater?
Yeah, you can aggregate those numbers
Okay.
to add up to it.
Same thing if you're selling two and going to one, you have to, the two
That
combined.
one should be a bigger property, at least in value,
Right.
to cover the value. of both.
The sales price, but what about the debt?
Well, when you do an exchange, there's really the two things you want to do. One is, again, don't touch the money. Roll all the funds or the equity. So you want to match that equity from the old one to the new one. But then you want to match that price also. So if you sold something for 500 and you got a 250 mortgage, you got 250 of equity, you got to roll that whole 250 over. The new property then, of course, would have to be at least 500. So if you got 250 to spend, you got to spend at least 500. Because you paid off that old mortgage at 250, you're obviously 250 short with buying that new property or more, depending on how much that new property is worth. So it typically means you're taking out a mortgage on the new property to cover whatever that difference is to make that purchase. It is possible to put in more cash out of pocket if somebody wants to do that.
Or if you have one property that was paid for.
Doesn't hurt anything. Right, yep. But because you gotta match the equity and match that price or more, then if you paid off an old mortgage, you're short cash, obviously, so you just gotta come from somewhere.
Yeah, I think our scenario, as you mentioned, was just that, Patrick, we sold one. We wanted to take the opportunity with the equity that we had in the sale to multiply that. So we ended up buying two, and we brought a little bit to the table in order to make those two work from a loan and down payment perspective. So it was actually a really great opportunity to get one property, turn it into two, without having to refinance. I do a cash out or anything like that. So that worked really well. Worked really, really well. All right. Other thoughts, questions?
I was just thinking about when you said, people who may not want the seller to know that they're doing the exchange, doesn't the PA have to have that language either way?
It doesn't.
Oh,
No.
it doesn't, okay.
The seller does need to get notice of the exchange, but that can be done up to or at closing.
Okay.
So our paperwork always asks for that seller to sign something saying, yeah, I'm aware of the exchange. I recommend put it in there, as long as you're comfortable with that, and we're covered. Our paperwork will still cover it too. So technically, no, there aren't any rules that say it has to be in the contract, but most people in the exchange world will say, yeah, put a couple sentences in there, just so the seller doesn't give surprise later. So I still recommend it. But if for some reason you really didn't want to do it, it can be covered at closing, everything that is required.
Anything else, or have we exhausted the topic, at least to this point?
Or just really to understand.
Yeah. No, it's, obviously Patrick is very well versed, and it's just a superpower tool. You know, the tax burden doesn't go away, but it allows you to keep that money in play, right? That capital is working for you, especially if you're going to take one and turn it into two or a larger property, whatever the case may be. So it's a super cool tool, and I don't know about you, but I'd rather have more capital in my hands today to multiply over the years rather than have to chop off a piece for taxes every time we go through a process.
I get people whose accountants say, well, you have to pay the tax eventually, so just pay it now. Which
It makes me sick to my stomach to hear that.
I suppose if you knew the capital gains tax rates were gonna go up next year, that might make some sense, and you were gonna sell next year.
Isn't that proposed? Do you know? Like, I had heard that it was gonna go to 40%, but that's what's on the table right now.
I don't have any idea what's on the table.
Only if they totally want to collapse it.
Yeah, there's certainly, right. So the last couple of years, there's certainly been proposals to raise capital gains tax rates.
Too many politicians own properties though. That's not one of the areas they'll raise it on.
Yeah.
20 to 40 is a big jump.
Yes, so there's been proposals, different proposals from different people. Whether that comes together and when is Washington, and I've given up trying to even. So I've never quite wrapped my head around that either. I think it's the accountant saying, I don't want to report your exchange because I don't know how that works, so just pay the tax because that's easier for me to report. I swear that happens sometimes.
And you're fired.
I swear it does happen. But yeah, that's always my thinking too. Again, I suppose if you know you're going to sell that property soon, maybe you just do it now. If your tax picture is going to change, like in 2 years you're going to sell this new property and you're going to have a big boost in income, so that 2 years from now your capital gains rate will be higher than it is now. Possibly that scenario works, but as a general rule, why pay tax today?
And I think probably part of it is where you're at in your life cycle, right? Yeah. I'm hoping I'm gonna be around a while, so I'm hoping I've got lots of time to take that current tax savings and put it to work for me. Yeah. If I were 30 years down the road and there was proposals to change capital gains tax rates, well, maybe that changes.
You'd probably be in a different tax bracket too.
Might
A lower
be,
tax bracket, right?
Yeah.
There's just so
hopefully.
many what ifs
Well,
down
and
the
I
road.
moved into one that I was in it for 8 years till this year, and so my house is, you don't have to pay any capital gains on it anymore. We do have some depreciation, but.
So, yeah, there's just so many what ifs down the road to figure out.
Yeah, who knows, right?
Yeah.
It's a yo-yo.
And I think that customer then, which really made me do this, because I think that customer started asking me about how capital gains tax works when you pass property through an estate. Well, it essentially disappears. Heirs get what's called a stepped up basis. So they don't have to deal with, the gain disappears. Right? They don't have to deal with gain from whoever they inherited property from.
No.
They start over with a market basis, essentially. So somebody could do that exchange, roll that tax into the new property. If they then pass away years down the road, all that gain from the old property and any gain on the new property just goes. So that's obviously for older customers, but that's always something to consider.
All right, anything else?
Thank you.
You're welcome. Yes, thank you very much.
So everybody should have a handout, should have Patrick's card. I would assume he'll be at the top of your list for 1031 needs and referrals. Anyways, thanks for the questions, guys.
Thank you. Thank you.
Yeah.